Hello, I'm Daniele from Zeygos, and today I'll be sharing with you an analysis of the financial markets prepared by our research office. If you appreciate our content, I invite you to subscribe to the channel. Pre-opening commentary. Interest rates, growth, and oil. Another rather intense week is about to begin for the financial markets. Wednesday is the day of the Fed, a day when traders will be looking for more details on the future moves of the American Central Bank, especially in light of recent macroeconomic data and the upward trend in the price of oil, which, as I write, is trading above $91 per barrel. Predicting the future actions of the Fed is not an easy task, and it's probably not easy for the members of the FOMC who are called to vote and express their views in the dot plot. Currently, the market is embracing a higher for longer scenario characterized by a still robust economy and a Federal Reserve (Fed) firm in the tightening process, which sees another likely hike at the November meeting, followed by potential cuts in 2024. According to June projections, these cuts are expected to amount to 100 basis points and should occur in the second half of 2024. However, this scenario, confirmed by the pricing of rate swaps, now completely aligned with the Fed's projections, could be challenged by two contrasting factors: a macroeconomic slowdown exceeding expectations and a surge in inflation. There are risks that the U.S. economy may slow down. As time goes on, the erosive power of higher interest rates on corporate profits and the purchasing power of households becomes increasingly evident. If we add to this further erosion of corporate margins and household purchasing power due to rising energy costs, the chances of a macroeconomic slowdown increase further. Therefore, in the SOFR, secured overnight financing rate, options market, there are already those betting on significant rate cuts by the Fed between March and June of 2024. In Friday's session, options premiums worth $10 million were purchased. These options become profitable in the presence of cuts exceeding 200 basis points. If this scenario were to be confirmed, we could witness a gradual steepening of the U.S. curve. Short-term rates would decrease more than long-term ones, in a context of a progressive decline in all yields of the U.S. curve, benefiting the equity sector. In such a scenario, growth stocks, especially tech stocks, would benefit from the rate cuts and continue to outperform so-called value stocks, which are inherently more exposed to the macroeconomic cycle. But the equation to solve is not so simple. It is getting complicated with tensions in the oil market, which continue to push up crude oil prices, making traders increasingly nervous about the inflation theme. The question that many are beginning to ask is this: what will the Fed do in the presence of a stagflation scenario, characterized by declining growth and still rather sticky inflation due to energy price pressures? Such a scenario would be negative for all asset classes. The bond market would struggle to discount a more accommodative Fed. Short-term interest rates would remain at elevated levels, as would long-term rates. And the upward movement in interest rates in the longer part of the yield curve, which we witnessed last week, suggests this scenario. So, while just a few weeks ago, the components of the equation were only two, rates and growth, now one cannot navigate the markets without constantly monitoring the price of oil. Further upward movements could stress the resilience of the markets because they would lead traders to anticipate a scenario of high long-term rates, likely associated with a growth slowdown. Yes, because this strength in oil is not demand-driven but supply-driven. As a result, high oil prices can still coexist with macro slowdown scenarios associated with high interest rates, necessarily still high, to combat persistent inflation. This scenario, characterized by macro slowdown, high energy prices, and high interest rates, would be negative for equities, putting pressure on both value stocks, more exposed to the macro cycle, and tech stocks, more exposed to rate hikes, and adding pressure to the bond market where those who bet on significant rate cuts in 2024 may have to reconsider their view once again. So, in summary, for directional operational decisions, it becomes indispensable to follow the price of oil. It is the driver. For more information, please visit the website www.zeygosonline.com. If you would like to receive our services on a free trial for 1 month, please email us at info@zeygos.com. Zeygos provides informational and analytical services only regarding financial markets and does not engage in any form of personalized investment advisory activities.